Hey, what's up, everyone? We're gonna jump in again and continue with our analysis of ClearSecure. Today, I'm gonna talk about the financial statements. I know in our last video, we talked about our strengths, weaknesses, opportunities, and threats of ClearSecure, what I like about the company. I said I wanted to mention more about their network effects, but today I want to talk about and just jump in straight into their financial statements. In their 2023 free cash flow statement, they brought in $225 million. And then capital expenditures came in at about 25 million. So if we subtract that out, that's about 200 million roughly of free cash flows in 2023. If we look back in 2022, 168 million in operating cash flows, and subtract that 31 million in property and equipment to about 136 million in free cash flows in 2022. In 2021, 69 million in operating activities. Subtract that capital expenditures, 28 million, that is 41 million in free cash flow. So it's fairly strong growth in free cash flows from 41 million to nearly 200 million in free cash flows. But we have to dive a little bit deeper. So 2023, 50 million in net income. And we'll jump into that a little further too, but let's take that 59 million in income and then they add back depreciation. They add back amortization, that's okay. But look at equity-based compensation. The largest item here is roughly about 37 million in equity-based compensation. You know, it's important to retain talent. How do you retain talent? Well, you give them stock options. That's a big one without spending too much expensing that. But that is an expense, right? That will dilute shareholders, especially us, when we come in from the outside. We want that, but we also want that to remain relatively stable. So we're going to continue to monitor that equity-based compensation. A lot of that operating cash flow is coming from that. Another big item here I see is the deferred revenue. Really, what is that? We're adding that back because this company is a subscription company, and because of that, payments are made upfront, and they need to incur that over time, right? But that payment, that's raw cash that they made in the beginning of the year, or beginning of the payment. That's 92 million in cash flow. I like to see that. That's a lot of the cash. You know, I want to talk a little bit more about, let's talk about their cash flow margins. We have about 200 million in free cash flows. So we can take that 200 million and we can divide that by the revenue. So if we jump back to the income statement, we can see in the income statement that revenues are about 613 million. So if we take that 200 million divided by 613 million, that comes out to about 32% free cash flow margin. Let's do the same thing with 2022. So 2022, remember that we saw that free cash flows were 136 million. That's taking the 168 million operating cash minus the capital expenditures 31. That's 136 million. So we take that 136 million divided by the revenues in 2022, which were 437 million. That is roughly 31%. So the free cash flow margin is strong, remaining above 30%. That's great to see. Now let's jump back to the revenues. We can look at the revenues briefly. We can see that revenues grew from 253 million in 2021 to 437, nearly doubling, to 613 million, about a 40% growth. That's amazing growth. You'll also notice some of the larger items here are general and administrative and cost of directors and salaries. A lot of the equity-based compensation, stock-based compensation is in that expense, and we saw that in the free cash flows, right? Another big item I want to jump to is the income. Now you see the operating income was only about 20 million in 2023. Why the big jump all the way up to net income to nearly 50 million? Well, the big jump was because of the interest income of 29 million. Is that sustainable? Where's that coming from? Well, that's actually coming from their marketable securities. In the last year, 2022-23, we had a high interest rate environment. So a lot of their marketable securities were invested in higher short-term investments that produced income for them. So that's great. But is that sustainable? Well, that probably will be variable going forward. That probably won't be as stable as we think. The operating income we should be looking at is 20 million, not this 50 million, nearly 50 million in income. So let's dive deeper in where that's coming from. We'll go to the balance sheet. Now let's look at what we have here. Let's start from the top. We have cash and marketable securities again. Look at that marketable security line, $665 million. That's amazing. 57 million in cash. So they have a lot of cash here. You look at their liabilities though, they don't really have much debt. They have some other long-term liabilities, 123 million. They can literally pay that off. They don't have any debt. That's a really strong balance sheet already, you can see here. What I like to do is understand more about why this is the case. You'll notice in their liabilities, they have their deferred revenue, 376 million. Again, the business model is a subscription-based model. You're paying upfront for that service, to have expedited service to get through airports and venues, right? You pay an annual fee. And that money is literally considered float. They can use that. They don't have to incur it. They can incur it over time, but they can use that. That's cash that's upfront that they can invest in things and do and make acquisitions and invest in marketable securities. And then you can see the marketable securities line. If we jump through to understand what they're investing in, you'll notice that the marketable securities are in U.S. Treasuries and corporate bonds, very short term. And that's good. That explains why that high interest income in their income statement was so high, around 29 million. Let's talk about that model. So that float model, that's a great model to have, to be able to have that deferred revenue. They essentially almost have negative net working capital. And all they need to really worry about, what is net working capital? So working capital is your current assets minus your current liabilities. All right, if we look at the current assets were at 770 million. We subtract out the current liabilities of 552 million. Very small working capital line. But a lot of that in that liabilities was really, if we subtract out the cash though, once we subtract the cash, because that's cash 675 and 57, you have negative net working capital. And that's really because of a factor of that float, of that deferred revenue, that money that can be used to invest in marketable securities or other acquisitions. So I'd like to see that. That's great. Okay, another thing I like to do is I want to calculate their return on tangible book equity. And, I'm a very big Warren Buffett type, right? Warren Buffett, that's one of his favorite ratios, the return on tangible book equity. How can you calculate that? Well, you take their equity and you subtract out their goodwill, about 62 million in goodwill and 20 million in tangible assets. And so when you do that, you get roughly about 285 million in tangible book equity. And we wanted to understand, is the business growing and returning on top of that? With all their investment of their assets minus their debt and their liabilities, are they actually utilizing and returning a good return for us investors? I would take the 50 million, right? But remember, we talked about that 50 million. A lot of that is interest expense. So I really want to look at, the operating income. What's the operating income bringing in? And it's about 20 million. So we take 20 million divided by the 285 million, and that's only roughly about 7% return on tangible book equity. That's okay. How about if we look at the cash flows though? We include the interest income, we add back the depreciation, we add back the equity-based compensation, everything that is actual cash, and we subtract that at capital expenditures. That's about, our operating income is about 225 million, right? We look at that 225 million and we divide that by the 285 million. That's nearly 78%, right? 70% cash flow return on tangible book equity. That's an amazing return. In reality, we probably should take out the capital expenditures of 25 million. So we're talking about a nearly, let's say, 60 to 70% cash flow return on tangible book equity. Really good return. Really, we want to look at, again, I talked about their equity-based compensation, we want that to remain stable, and then that interest income, we probably wouldn't expect that to be as high as we've seen there about at 30 million. Those are some of the things I like to look at, I think are very important to look at. The operating cash flows are growing, the free cash flows are growing, the return on tangible equity is okay. The cash flow return on tangible equity is very strong. We like to see that. As we continue to monitor this company, as they continue to grow their network, their effect, their user base, and build more partnerships, I would like to see that cash flow remain high, the cash flow margin remain high, and I'll be very excited about this investment. I think they can really grow. So far, really love the cash flows, love the balance sheet. Like I said, negative net working capital, great balance sheet. Utilizes that float, that deferred revenue. They can utilize and invest in the acquisitions, invest in their marketable securities, strong balance sheet, strong growing income statement of revenues. Very excited. I hope you like this video, and I will talk to you till next time. Thanks guys, bye.